Hey everyone, welcome back to another dividend investing video. Hard to believe we're nearly halfway through the year 2023 and the S&P 500 is up nearly 13% and the Nasdaq 100 is up about 34%, putting both around their 52-week highs. So far 2023 is turning out to be a bull market led by the tech stock rally, much of it surrounding hype around AI. Now in today's video, I'm going to talk about what I'm doing right now, where I'm focused, and what I'm not doing. This is from the perspective of a value-oriented dividend growth investor. I'm going to take a look at a couple sectors where I find value right now and point out some quality dividend growth stocks I like right now and ignore all the hype. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Here are the top 10 holdings in the S&P 500. It's become extremely tech-heavy due to how much companies like Apple and Microsoft, Amazon, and Nvidia have experienced explosive growth. Notice that Apple and Microsoft have become so massive that they take up about 15% of the market cap of the top 500 companies on the US market. Think about how huge these companies are. Apple is up over 46% year to date, approaching all-time highs. Apple shares have gained a mind-blowing 10,080% over the last 10 years. Now, Microsoft is up 38% year to date, right now, right below that 52-week high. Amazon up 47% year to date. Then you have Nvidia, a mind-blowing 186% price gain year to date on their shares. And another one that's up huge is Broadcom, and this is one of my favorite dividend stocks that I own. My own position is up 50% just this year. Now, if you follow this channel, you know that I'm a huge believer in dollar cost averaging into ETFs like the S&P 500 index funds to build wealth. And whether it's at its 52-week high or 52-week low, I've been buying VOO every week. And my own 401k automatically buys into an S&P 500 index fund. And the idea with dollar cost averaging is we buy periodically no matter what. And the idea is over time our average cost will become the average price the index was over the time period we were buying. Now, historically, yes, the S&P 500 brings in an average annual return of around 10%. Fast forward many years into the future, all that dollar cost averaging you did years and decades ago, hopefully, should pay you substantially. Last Wednesday, I bought a little bit of VOO, and I'm going to buy it again this week. On the way up, on the way down, I'm buying it. But here's what I'm not doing, okay? I'm not getting FOMO with that group of tech stocks I mentioned earlier. This is one pitfall that is very common for new investors to fall into. Certain stocks start flying, they go up and up and up and are seemingly headed to the moon. Investors start buying into it, even start seeing some nice gains, but most of the time bubbles pop, and that leads to pain. We saw this at the beginning of 2022, when most of these stocks were at all-time highs and began to drop, which resulted in the bear market of 2022. Now, investing takes discipline. In my opinion, the time to buy, those stocks that are running up now, that was 6 to 12 months ago. So I'm dollar cost averaging into my SCHD and my VOO and most ETFs. And I think dollar cost averaging is a fantastic strategy, but be careful. We are in a bull market. For instance, the QQQ, I would not dollar cost average into this one personally, just my own opinion. The Nasdaq 100 has much higher volatility, and buying into this one, in my opinion, does require a little bit of timing. Of course, there's more time on your side, the better you are, but the more room you have to make up for your losses. And the Nasdaq is super concentrated mainly on that group I just talked about. So right now it's up 37% year to date. Could it keep going? Of course it can, but as we saw recently, bubbles do pop. Check out CNN's here's Fear and Greed Index. They take a bunch of indicators that measure some aspect of market behavior and come up with a score that represents the mood of the market. 0 being maximum fear, 100 being maximum greed. At the moment, this index falls into the extreme greed category. While I preach keeping emotions out of your investing, many investors are emotional and reactionary. And I'll put a link in the description to this page on CNN. I think it's an interesting thing to follow. And when you see it at this extreme greed, it's a good time to be cautious. Even though we have an S&P 500, though, at all-time highs, there is a lot of opportunity in the market, especially for dividend growth investors, value-minded investors like myself. In fact, I'd say this is a great time to be a dividend growth investor to see this All you need to do is look at the dividend ETFs. SCHD is down about 4% year to date compared to the 14% gain on the S&P 500. Now here are the top 10 in SCHD right now. Lots of healthcare, and you got Pepsi, Coca-Cola, Home Depot, classic dividend stocks. And the chance that SCHD underperforms the broad market are only going to get louder and louder as the bull market continues. But for those of us focused on building up a dividend growth portfolio, these opportunities allow us to lock in a better yield on cost on ETFs like SCHD and other classic dividend stocks, quality businesses, blue chips. And I'm happy to be able to buy SCHD here around that $70 mark. And the beautiful thing about dividends and building a dividend growth income portfolio is that whether we're in a bull market or a bear market, if we've invested in companies with stable cash flows and well-run businesses, we can expect that our dividend income will continue to pour in, and ideally it should continue to grow year over year. This is one reason why I like to focus on dividend growth stocks. And right now I think there are 3 sectors that have some value. These are where I am focused, at least myself right now. The first sector I'm focused on right now is healthcare. And we can look at XLV ticker. This is a ETF comprised of all the healthcare companies on the S&P 500, weighted by market cap. This includes healthcare providers and services, healthcare equipment, biotechnology, and pharmaceuticals. The sector as a whole is down about 3% year to date. And over the last 10 years, however, its total returns just about match the S&P 500, the broader market. There's some really high quality companies here for dividend investors. Let me tell you the stocks I think are obvious buys right now that I'm buying. I'm talking about Pfizer, ticker PFE, Amgen Inc., ticker AMGN, and Medtronic PLC, ticker MDT. Pfizer looks really compelling here when you can lock in that 4.21% yield on shares right now, which is 15% above its 5-year average. I've been buying Pfizer. I've also pointed out Amgen in a recent video for stocks I like for June 2023. This biotech company is hitting all my green flags for buying right now, with double-digit dividend growth to boot. Medtronic is a medical device maker, been growing their dividend for about 45 years. The last 6 months was the first time investors were able to lock in a starting yield of over 3%. This has been one of my favorite stocks to buy for 2023, and I've been buying it up all year, and I'm going to continue doing so. Now, the top 2 stocks in the fund of XLV that make up 20% of the healthcare market on the S&P 500 is United Health Group and Johnson & Johnson. I do own both of these companies. I believe both are at reasonable prices right now for long-term holds, kind of a fair value. Buying into massive, giant companies that are high quality, well-run, well-managed. I bought some UNH just last Wednesday, actually. Now, Merck and AbbVie, both of these look like they are more in hold territory for me. I could be letting the fact that my cost basis of AbbVie is $100 clouding my judgment, but its dividend yield is 10% below the 5-year average, while its PE is way above its own 5-year average. It's a fantastic company, stellar dividend growth, and I'm happy to hold it. But Amgen looks better right now as far as timeliness goes. And AbbVie is down 15% year to date, so there could be some opportunity there. These are 2 great companies, both of them. Great dividend growth stocks that belong on the watch list at the very least. And I think now is a great time to increase exposure in the healthcare sector. The opportunities look like they might be there for some time, which is nice for those of us who are just trying to accumulate, be a dollar cost averaging every week or whatever. In full disclosure, for this sector, I have bought Pfizer, Amgen, United Health, and Medtronic in the last 30 days, and I also hold Johnson & Johnson and AbbVie. Now, on to the next sector, financials. We had all that craziness with the regional banks earlier in the year, and even the big banks like JPM and Bank of America fell hard. The sector also gained a couple giants in 2023 in Visa and MasterCard. They were moved into the financial sector from the information technology sector this year. Year to date, the sector is down over 3%, compared to the S&P 500 being up 13%. So this might be a good time to look at financial stocks. Now here's XLF, sector-weighted ETF. And in that top 10, the largest in the sector is Berkshire Hathaway. They don't pay a dividend, but I think they're worth looking at real quick since they make up 13% of the sector, so the largest company. Their shares are up about 8% this year, but I think a huge part of that could be attributed to the very large stake they have in Apple. In a lot of ways, Berkshire Hathaway is like buying an index fund, but again, they don't pay a dividend, so you owe this one solely for capital appreciation. And it's an excellent stock, really, but not one we really get to talk about much on a dividend investing channel. So what looks good in the sector right now? Bank of America is the obvious one to me, ticker BAC. I've been buying this one for the last 3 months. It's down 12% year to date, but analysts give it a price target of $35.55, and that's a 21% price gain from where we are today. So there's a lot of upside with Bank of America, I think. And with a sweet 3% yield, average annual dividend growth rate of almost 3% over the last 5 years, this is the bank stock to be in right now, in my opinion. JP Morgan is great too. I'm kind of putting that one in hold territory. They've had a much stronger year and have not been raising, or they may be not able to raise their dividend in the last 7 quarters. It's going to be telling what happens when they announce their dividend for October, because that would break their dividend growth streak. Now, I was buying JPM in 2021, not really buying bank stocks in 2022 because they had run up, but in 2023, I started a position in Bank of America, sort of as a complement to my JPM position, because like I said, BAC just looks like a better value right now. I would also put Visa and MasterCard both in the buy territory. If you like these kinds of stocks with low dividends but high dividend growth and higher share price growth potential, these companies are cash flow machines. If you're okay with some volatility, you're okay with holding for the next at least 5 years, I think you can't go wrong with Visa or MasterCard. Both feature double-digit dividend growth. Their price targets are both 20-30% above their current prices. The last company in the financial sector I think I'm going to point out for dividend investors right now is BlackRock Inc. They are down about 3% year to date. And if you invest in any iShares ETFs, these are managed by BlackRock. So this company is gigantic. They manage a ton of assets. This is a quality business that looks like a fair price to me. 2.9% starting yield. That's about 8% above the 5-year average, and the company has shown a commitment to both increasing its dividend and reducing its outstanding share count. The final sector I want to talk about, where I'm finding some value, is utilities. And this is a sector I only like buying at certain times and only in smaller amounts. It makes up 2.6% of the S&P 500, very small, and I keep my own exposure in the sector about the same, between 2 and 3%. You can invest in this sector in one fund with the XLU ETF. This is a market cap weighted fund of all utilities on the S&P 500. Year to date, XLU is down about 6%. And I don't normally buy sector ETFs, but if I was going to, I think the utility sector, XLU, this is a decent candidate for that, because a lot of these companies are really similar. They're slow growth, high dividend. Most of these are regulated utilities, and there's a reliability to their cash flow. And this ETF pays a dividend just over 3%, slow dividend growth. Many investors stay away from this because it underperforms, but I think putting a small chunk of it in your dividend portfolio makes sense for cash flow purposes. And my plan is to slowly increase my exposure to the sector over the next 10 to 20 years. Once I'm living off dividend income, it'll make a lot more sense to up my exposure to companies like this. Right now, it's going to be the smallest component of any of my dividend portfolios. Here are the top 10 holdings of XLU, as I'm showing you. NextEra Energy, ticker NEE, is the largest at 15%. And in my dividend portfolio here, I'm growing on the channel, I've been buying into NextEra Energy. In fact, I'm buying some Wednesday, the day I release this video. It is, in my opinion, one of the strongest, if not the strongest, dividend growth stock in the utility sector. Double-digit dividend growth. And it's a dividend aristocrat with 27 years of dividend growth. And right now, shares are appealing, looking from both a dividend yield theory perspective and when comparing against its historical PE. NextEra shares are also down 11% year to date. Another great company I like in this sector is Duke Energy. Duke Energy, with its 4.43% starting yield, looks to be at a reasonable valuation, and one I would look to potentially add if it drops around $80. That gets you that 5% starting yield, and it's not impossible it could drop there again at some point. Shares are already down 12% year to date, so I keep Duke on the watch list. Utility stocks have their place in a dividend portfolio, perhaps yours. I continue buying NextEra in my portfolio here. I'm building on the channel. And be sure you're subscribed for my next video in that series, where I'm going to go over what I'm buying this month in June and the growing dividend income I'm collecting. The point I'm trying to convey, hopefully though, in this video that you're getting, is to stick to your plan. Don't get caught up in hype and FOMO and emotions. Look, if you didn't buy it before it was being hyped up and it ran up, accept that you missed the boat on that one. And sure, Nvidia can run up another 100% before it pops. Maybe it's going to go up another 200%. But look, I can smile knowing I did buy into Apple and Microsoft and Broadcom at better times, and it's paid off for me. Buying and holding quality companies does pay off over time. And right now, I'm focused on the sectors healthcare, financials, and utilities. That's where most of my purchases this month are, outside of my usual dollar cost averaging ETFs. Now, I want to know down in the comments, what stocks are you buying right now? Any of the ones I mentioned? Let's share some ideas with each other and continue to grow as Dividend investors. And hey guys, I'm getting really close to getting 8,500 followers on Twitter. My goal is to try to get to the 10,000 follower mark before the end of summer. So follow me there at Div Growth Income. Great way for us to keep in touch. Thanks so much for sticking around, and until next time, keep investing.